Thanks for joining us on another STANLIB webinar. Hope you're keeping well. We really appreciate you taking the time. There's a hell of a lot going on in terms of developments in and around South Africa, and obviously there are lots of events happening, so we really appreciate you focusing on our event. So what we're going to discuss today is we're focusing on equity markets. Particularly, we're going to focus on the STANLIB Global Select Fund. But as we go through that discussion, we're going to delve into some of the aspects of equities in terms of earnings, valuations, and some of the other big topics that are obviously impacting the market. In order to do that, we are privileged to be joined by Amit Parmar, who's from JP Morgan Asset Management. He's an investment specialist. He's out in South Africa for a few days. He's been in Cape Town. He will be at a conference tomorrow, and we've got him for an hour this morning, and he's going to give us some sense of what's happening to the Global Select Fund. And he's got a huge amount of knowledge on the fund, but on a whole range of other topics. And he said we can ask him literally anything. So we're going to avail ourselves of that opportunity. Amit's going to be using quite a few charts. This isn't a sort of a formal chart presentation. It's more of a discussion. I'm going to be asking Amit some questions as we go through, but he'll use some charts to maybe elaborate on some of the topics. Please, those charts are available if you want a copy of that. That's no problem. Also, please, if you want to ask any questions, there is a chat section, so please just type up a question, and I've got my phone handy. I'll be looking for those questions as we go through the discussion. So if you see that I'm on my phone, it's not that I'm deciding to look at other content. I'll just be looking at what's happening on the questions. The last thing before we start, I just want to mention this has been filmed in Johannesburg, where it's nice and sunny and warm. It's actually a beautiful spring day. If you're somewhere else in the country and the weather's not good, that's kind of your problem, Cape Town. So without delaying the process any further, I'm going to hand over to Amit to give us, to start with, just a quick recap on the STANLIB Global Select Fund. In other words, give us a sense of what it's about, what it's trying to achieve, before we get into some of the more kind of minute detail around global equities. Amit, thanks for joining us. Welcome. Welcome in South Africa yet again. I don't know how many times you've been here, but it's a number of times. We really appreciate you being here. So maybe just start off by giving the audience a sense of the Global Select Fund.
First off, Kevin, let me say thank you so much. Thank you, everyone, to the hospitality that they've shown me on every single trip that I've been out here. It's always a pleasure. This is now my 5th trip. Wow. So it's becoming a second home, and it's absolutely love coming out on every single occasion. So to your point, I'm very much just going to give you a very quick refresh on what we're looking to accomplish in Global Select, and why as well we've brought this particular strategy to market as well out here, and what really the philosophy behind the fund is. And so just for a very quick history lesson in terms of the genesis behind Global Select, the strategy has been around since the 1980s, but in its current form really since the end of 2015 under the current management team led by Helgi Skibeli and Christian Pescher. And what we're looking to do within Global Select is we have a network of around 80 analysts located around the world, all of whom are dedicated to their sector within their region. So think about it this way: a US utilities analyst, a European utilities analyst, an Asian utilities analyst. You get the idea across all of the sectors. And we're distilling down their research outputs, their estimates, their forecasts, into a portfolio of between 65 to 95 stocks, but typically 70s, low 80s. That's the sort of range of holdings. And we're picking those from a universe of more than 2,500 stocks that we have under coverage at JP Morgan. Now, what are we looking to accomplish within the portfolio? It's a core, style agnostic, all-weather portfolio built on stock selection and built on, we call it idiosyncratic risk, stock-specific risk. So it's that stock selection that's going to drive either the outperformance or the underperformance, rather than any quantitative screens, rather than any style tilts that we're taking. Growth, value, cyclical, defensive, these sorts of conversations we try and neutralize for as much as possible. And the strategy has had tremendous momentum behind it. Within the region, we've raised plenty of assets here, but more broadly, globally, we've also raised now upwards, getting towards 50 billion of AUM going into JP Morgan Global Select. And so from a STANLIB perspective, when we decided to partner with them and bring some of our core flagship offerings, this was the obvious choice when it came to an equity offering, an active equity strategy, concentrated in nature, and really leveraging those analyst ideas. And you've got a very, very experienced portfolio management team at the helm, who are then in charge of managing the portfolio in a very disciplined, risk-controlled way, so that we're not overexposing ourselves to any one particular stock. And we're always taking profits on certain names as they're outperforming and reallocating elsewhere as we're underperforming. But crucially, that's driven again by analyst insights, and stock selection is driven off the back of analyst inputs into this process. And performance since the strategy is launched under this management team has been very, very strong. More near term, and we can go into this, it's faced a slightly more challenging time. But this is, at the heart of it, very much a bottom-up equity stock selection driven portfolio.
So Amit, it's fair to say that this is kind of your best of breed. This is the best. How many stocks would typically be in the portfolio? So you're analyzing a huge number of stocks, right? You said over 2,500 stocks that you've got analysts looking at. How many of those 2,500 make it into this portfolio typically?
So the sweet spot, we believe, for a core risk-controlled portfolio, between the 70s, we guide towards 65 to 95, but it tends to be in that 70s to 80s.
So this is 70 of your best ideas in this portfolio. And then obviously, as you go along, analysts are trying to recommend other shares that should go into the portfolio, suggest shares that maybe should come out of it. So it does move around. It's not as if this is a static portfolio, but equally there is a degree of long-term holding that underlines the portfolio, right?
Yes, absolutely. And we make our stock recommendations based on really 3 to 5 year earnings estimates. Now, that doesn't mean we hold each holding for 3 to 5 years, but it does mean that we're trying to peer through the near-term noise of the economic cycle to make those recommendations. And in terms of the actual holdings range, when you have such a broad universe that you're picking stocks from, we could, of course, construct a 20-stock portfolio, a 30-stock portfolio, but you're then running into this scenario of one or two particular names are effectively dictating your entire portfolio returns. By having this holdings range of, let's say, 65 to 95, we're able to diversify sufficiently. We're able to capitalize on a number of trends around the world, structural growth areas, without sacrificing the potential for outperformance, but also by being very sensible, by being very risk controlled in terms of the manner with which we're doing so. So we view it very much as the sweet spot between balancing diversification, alpha generation potential, outperformance potential, and then also the risk management side of it as well.
So if I challenge, let's say somebody challenges you and says, look, at the moment, there's a handful of tech companies, they are driving market performance, and that it's just a question of whether you have those tech companies in your portfolio, then your portfolio does well or not. How would you counter that as a kind of generalization about global equity funds?
It's difficult to argue against that point just at the headline level. Mag 7 has become such a popular message within headlines, the financial press, and it's easy to understand why. The market has been led by this handful of names, and let's say Mag 7 plus a handful of others, 3 or 4 other names which have really driven margins over the course of the last couple of years. I don't think at the headline level that's not an unfair assessment given the magnitude of performance that's come from them. The S&P 500 is now upwards of 20% just driven by information technology. This is almost unprecedented in terms of history as far as that market concentration goes. But it's very interesting when you say that, because the point that I would always raise, particularly this year going into 2025, you've seen the European financial sector and European banks keep up with the NASDAQ. Now, where's that come from? If you were purely anchoring on just Mag 7, if you were purely anchoring just on those top 10 names within the US, you would have missed out on the incredible potential for names like UniCredit and the significantly strong performance that they've seen. They're up more than 60% on a year-to-date basis. Now, where's that come from? With full respect to the European bank sector, and I sit out in London, it's been an unloved child for so long and really overlooked by investors. But suddenly, after years and years and years of being overlooked, being punished by investors, and management of many of these institutions restructuring, focusing on buybacks, focusing on dividends, repositioning their strategies, you've seen this incredible re-rating. And UniCredit is the poster child for that. And I'm not proposing to turn this into a pitch on UniCredit, but the point is you've got this incredibly strong management team, you've got a strong balance sheet, and you've got clear strategic vision from the team leading the institution. And when you then look at the returns that they're achieving on the valuation that they started from, it's very competitive with those large names, which are talked about a great deal more. And that's why it pays to have a global research platform and analyst coverage across a range of sectors. But also, in terms of those 65 to 95 holdings, we want to be owning some UniCredit in there. We want to be owning many of these pockets of markets that have performed well and we believe have that structural drive.
I mean, in essence, there are broader opportunities, and that you've got to be careful about. You just narrow your focus on these IT stocks, and you potentially are taking a lot of portfolio concentration risk, and there are opportunities out there. So let's just move on to the markets generally. If I look at it from my perspective, right, an economics perspective, equity markets have done well this year, right? If you look at South African equity market, it's done brilliant, I think, in both rands and dollars. If you look at European markets, they are up, even though the growth rate is weak. If I look at Chinese stock markets, have done very well. The Japanese equity market in the last week, it was up something like 4%, incredible performance. And obviously the US, pretty much some of the markets are at record highs. So you've got good, strong performance out of equity markets. And then in the background, you've got incredibly messy policy, the tariff policy from Trump. That's incredibly messy and uncertain still. You've got all the geopolitics around Russia, Ukraine, and you've got Israel, Gaza, etc. So why, from your perspective, why have equity markets done well?
So we've seen, and I would characterize this since 2023, AI and excitement over AI has really led the rally. But let's wrap up all of the, primarily in the US, let's wrap up all of those different factors you've just mentioned. And if we encapsulate it with, since this current administration came through, what's really dictated some of those returns. And just to highlight for you, in terms of the market trend that we've really seen, we've seen an incredibly strong period of momentum driving markets. And what we mean by that is investors have become so anchored on short-term revisions rather than long-term earnings. And there's become a bit of a disconnect there. We went through an extended period where investors were looking at long-term fundamentals. And now there's been this incredible rally as far as price momentum within the market has been. Now, what's the implication of that and why has that been caused? Part of it is politically induced. If there's good news, then we're forecasting the good news for this name will continue and we'll just keep re-rating and pumping up that stock. And we've seen examples of that. Look at names like Palantir on 280 times earnings. I think they've just come down a little bit since then. But names like that, look at the multiple that Costco is on, the multiple that Netflix is on, the multiple that many of these names are on at the moment. These aren't inherently bad businesses as far as Costco and Netflix, but the multiple and the valuation that they've reached, we feel that there is a disconnect there that's really emerged when we take into account how momentum-led the market has been. And the catalyst for that really was with the election of President Trump, and the shape of the market really changed since then. Now, just to illustrate from a stock selection perspective how this has played out, and just to give you an example. So the chart we have on screen here is Walmart and McDonald's. And this is showing the earnings revisions of each of those companies, the green line on the left-hand side, the red line on the right-hand side, the earnings revisions that each of those companies have delivered. Now, Walmart is up more than about 70% on over the course since the end of 2023. This is they're competing very well with Amazon. They've done very, very well in terms of a bricks and mortar retailer, and the strategy they've employed is fantastic. But do we believe the stock deserves to be up 70%? Probably not on 1% earnings upgrades. And likewise, in the case of McDonald's, where we have a great deal of conviction as far as the fast food retailers go. We love the business models that they've got. They're recurring real estate style business models. They've responded well to rising pricing pressures. Earnings have actually been downgraded very slightly over the period, but the stock has really remained flat. Now, in our view, we believe that McDonald's is undervalued by the market at the moment, and Walmart is very much overvalued. And this is largely that momentum coming to play. And just to illustrate it further, just on the next slide, you can see how similarly, and I appreciate these are different businesses that we're talking about. One is a bricks and mortar retailer in the US, and the other is a global fast food franchisee style business model. But they've traded historically on really similar valuations. And you can see there, right at the end of that, the jaws between the two lines, if we think about since mid-2024, the jaws between those two lines have just spread out and have continued to stay dispersed. And this just illustrates what we're seeing in the market as far as this outperformance of the momentum factor and the underperformance then on the other side of that of quality. And I mean, across many client conversations we've had since I've been here, quality managers have always seemed to be in vogue, very in favor. And you've seen this underperformance of quality. And the MSCI World over 5 years, the MSCI World quality over 5 years still outperformed the MSCI World. The MSCI World quality over the course of the last 12 months underperformed by almost 10%. And the momentum factor materially outperforming. So you're seeing that at play. And everything you've just described as far as the geopolitics, but take the catalyst of the US election, this is what's really driven that outperformance of that momentum factor.
Okay, so two things jump out at me. The first is you guys tend to be more biased towards quality investment. In other words, your portfolio, the construction you're doing a lot of kind of detailed work on individual stocks, and you really want to put best of breed quality in there. So this isn't an environment that ideally suits you, right? How do you approach that? Do you then say, okay, this is a momentum-driven market, so we have to start to be more momentum-driven? Or do you guys say, look, no, we're sticking to what has worked well for many years. We may underperform in the short term, but this is how we do things, and we are maintaining that philosophy. What has been your approach this year?
It's very much the latter of those. This process has worked for upwards of 3 decades. And historically, when it's underperformed, the coiled spring of alpha generation of outperformance then compresses and it shoots back very quickly when you see that reconnect of fundamentals. Now, that's not to say we don't have enough humility to recognize this backdrop could persist for longer. And the steps we've taken over the course of this year, and perhaps actually we'll move forward a few slides just to the positioning within the portfolio. The last time I was out here in South Africa, the last time we spoke and sat down together, if we think about these different quadrants on the spectrum of defensive and cyclical, high and low growth, we were taking much more meaningful overweights into certain cohorts of this. And we've brought our positioning right the way down as far as the cyclical versus defensive calls. So businesses which are much more exposed to the economic cycle versus those which are less exposed. We've also brought down our view on high versus low growth companies, or growth or value in terms of that spectrum as well. And the reason behind that is inherently over the course of this year, we were underweight, or we don't really play in some of those lower quality names, but we then miss out on some of those cyclical opportunities. And I really want to draw your attention towards that low growth cyclical bucket that we can see in this quadrant here. And an area we've added to quite meaningfully have been those industrial cyclicals. And to rewind slightly in terms of just our slide deck that we can see, what we're showing you over here is the output from our research analysts. So this is we call it normalized PE, but it's our JP Morgan valuation metric we use. And you can see the extent to which this really dipped in April, and it presented an opportunity at the valuation level in many of these cyclicals. And just to give you an example, so we didn't sacrifice on quality. We went for high quality cyclical businesses at attractive valuations. For example, Train Technologies. So for anyone not familiar, and I'm sat in a very nice air-conditioned room here, Train Technologies is one of the leaders in heating, ventilation, and air conditioning units in that technology. It doesn't sound very exciting, but when you think about all of the new buildings going up in the world, if you have good HVAC systems, it's not just a nice to have, it saves businesses money over time. And this is one of the highest quality businesses out there when it comes to developing these. They're a leader in terms of R&D. We initiated a new position in Train. Likewise with businesses like Eaton, which is a power management company, not a power generation company, but plug points, bus bars, these sorts of tools and applications that are used, and they're one of the leaders in that space. And both of these are US companies. And I know one of the questions which may come up later is on US exceptionalism, but it's very much don't throw the baby out with the bathwater in terms of the US trade, because they're still excellent quality businesses there. I've just named you two of them.
So can we just go quickly back to the momentum theme, right? So I agree with you. Momentum is clearly a very strong theme at the moment, and it can continue. From your perspective, what tends to change that? What tends to then, where the market says, no, I'm now going back to fundamentals. I'm going to go look at valuations, earnings, the quality of the company, the management. Is there a typical trigger that would then shift it? Because at some point, I've got no doubt that that's what will happen, right? And you guys, because you're sticking to that quality, I've also got no doubt that those equity that you've got in your fund will perform well. But what creates that catalyst?
Historically, if we look at it, and this is going to be a slightly grim answer that I'm going to give you, so I almost apologize. When we look at the previous pockets of significant momentum outperformance, and you can see it again, this is the chart we had up before. Look back to the late 1990s, early 2000s, and the sharp momentum rally that we saw in the lead up to the great financial crisis. What really drove that momentum out of the market was a correction in the equity market then. And you started to then get to the stage of that exuberance that was in the market pulling out again. Now, we saw a meaningful momentum rally, let's say end of last year, but the second half of 2024, which has really continued then going into 2025. Against this sort of backdrop, we don't have the crystal ball to think when fundamentals will reconnect meaningfully. But that is also goes back to the point of just balancing the portfolio as much as possible against this backdrop. We have sacrificed a bit in terms of quality, and we'll come on to some of our top 10 holdings. We've sacrificed slightly in terms of quality, but if we focus on that long-term valuation, we think we'll be rewarded for that over the course of the cycle. And then on top of that, if there is an inflection in the market,
then it would, yeah. But so in your discussions, is there a point in your discussions where you're saying, guys, this is an accident waiting to happen? Is there that sort of view that this momentum can go too far and that it can then result in a significant correction? Is that a real risk? I mean, that risk of a correction is always there, right? I've looked at a whole lot of stats and they'll tell you that in any year, there's whatever, 20% chance of a correction. Do you think that percentage has gone up meaningfully?
When we think about the previous corrections, and if we go back to 2021, that's probably the last time we saw a real double-digit correction where we had more irrational exuberance really being expressed in the market. Now, are there signs of certain companies and certain pockets of the market right now looking more toppy on those valuations and perhaps some evidence of froth there? Yes. Is it to the same extent as even 2021? Not necessarily. And the reason why is, by and large, many of the businesses that have performed very well, we're thinking about Mag 6, Mag 7 here, are still supported by free cash flow generation and a strong competitive position. So we don't think they're trading at overextended valuations. When we start getting into the territory of real late 2021 froth, over exuberance, irrational exuberance, that would be much more of a sign for that. For the time being, even with the narrow leadership in the market, and even with the most recent earnings season, you've still seen companies actually consistently beating on the back of that. There's weakening in some pockets of data, not dramatically so. Leverage numbers also haven't been dramatically elevated as in 2007 or 2008. And the message I would want to give is we're treading cautiously and just maintaining this view of balance. And that view of balance is what I'd really want to get across against this backdrop.
But obviously, if you had a big event where, let's say, you now were convinced there was a global recession about to unfold, or the US itself went into a recession, and that's not the base case. I mean, obviously, the US economy has lost momentum. There's some concerns about the labor market, but people aren't expecting that you're going to have an outright recession. And so what you're suggesting is that in that type of environment, the momentum can continue, and that some of these valuations are perhaps not ridiculous and remain manageable within the current context, right?
Correct. And this again is why, and history never repeats itself, but has a tendency to write, and that's a very famous saying, but we're thinking about how similar this year right now is to 2021. Going in from 2021 to 2022, we followed our analyst valuation signal, areas of the market that looked more undervalued. I put up the chart earlier as far as the industrials opportunity there. We're following the valuation signal there. And conversely, on the other side of that, and jumping ahead a few slides again, the other side of that industrials trade is actually what happened in the more defensive sectors. Now, we followed the valuation signal there as well. What performed incredibly well in the first quarter of the year, it was defensives. It was the term coined was bunker 7 stocks, the Coca-Colas of the world, the J&Js of the world, the stocks that held up against that backdrop of pockets of the market really correcting after DeepSeek as we went into more intense tariff-led discussions. These are the names that held up the best. In our view, they look more expensive now. So this has been our funding source for that cyclical allocation that we've increased over time. But this is still driven at the bottom-up level. And the shape of the portfolio over this year has very much been going from overweight those defensives, balancing the portfolio a bit more, but crucially adding some of that cyclicality into it.
Okay, I mean, can we talk about a couple of themes that are out there? We keep getting asked about them, and I think it would be interesting to get your perspective on how they are impacting your decision making. So the first, the obvious, is AI. It feels to me like, I mean, AI has been developed for the last 8 years, so it's not actually that new, yet it's suddenly dominating a huge amount of discussion. There's a huge amount of investment in software globally that's going on. It feels like it's meaningfully ramping up. So how do you guys deal with AI in terms of your fund? In two respects. The one is it being used to enhance your investment process? Is there a role for AI in trying to improve the outcome? That's the one. And the other is there a bias in the stocks that you're putting into the portfolio that you're looking at each stock saying, okay, is this company going to benefit from AI? Oh, yes, it is. Let's put that in the portfolio. To what extent is AI determining a lot of what's going on here?
We fully believe that AI will be very transformative for a number of industries. And day to day, and this is sitting within JP Morgan Asset Management, we have now introduced more and more tools which are employing large language models, for example. Now, from a stock picking perspective, this hasn't replaced a portfolio manager. It's not replaced a research analyst. But what it's done is made their jobs much more efficient. If you're given a 6-page report on NVIDIA, do you really want to be reading that word for word? Or if you've got your LLM there, you can just very quickly on our own proprietary software, we've developed our own versions of ChatGPT to go through that and say, LLM, pick me out and condense this into the top 3 points. It's very good for that. And it's led to lots of efficiency gains and given people back time.
Shame the analyst has written a 20-page report and you saying, just give me the 3 main points here. It must be quite soul-destroying for the analyst, maybe.
Not at all, because even on their side, then they can then also employ it in their own respect and say, look through this earnings transcript for certain keywords. Look through this earnings transcript for keywords that are then picking up on an LLM. So they can also take what indicators are coming from management too. And so at both ends of that, the research end, at the portfolio management end, it's a very useful tool to skim through lots of information quickly. And if you want to, then you're still welcome to deep dive into it. But it's the incremental gain from that. Likewise, as well, when it comes to monitoring our analyst performance, there's data science and tools really backing that, looking at their behaviors and biases over time. So we're introducing and implementing these tools. A year from now, we'll have different tools available to us, which are advanced, but it's a key area of focus for us. But it's something to complement, not substitute any of the investment know-how. And the reason for that is, if you want to get a differentiated outcome on a stock or a sector or a company, human know-how is still the most valuable. Human know-how is still going to be sitting in front of management of a company that's underperformed materially and say, okay, you've profit warned, your guidance is very negative right now, why should I still hold you? And ultimately, it's then for that management to say, look, we recognize this, these are the steps we're taking. And it's not an AI-induced report that's coming back to you. It's someone looking you back in the eye and saying, these are the steps I'm taking, and we acknowledge there's been things that have gone wrong. So we want both of those elements there. The human remains at the heart of it, but AI-based tools are AI-based tools. Now, on the other side of your question, an AI bias in the portfolio for businesses that are employing it, it's not dissimilar to what I mentioned. There's lots of discussion around monetization of AI and it replacing jobs. And you've seen some of that come through with layoff announcements, particularly in the tech sector. Salesforce, some of these other companies really instituting that, and that really coming through in the headlines. For other sectors, I think there's a lot of grappling with, well, how are we actually going to employ this? There's good examples, again, of using AI in pharma and biotech research. Okay, map this genealogy for me, which would take an individual days and days to do, and it's now able to do it within a matter of hours. So there's uses that are coming through there, but it's not necessarily biasing ourselves to AI beneficiaries. There's, of course, companies where if they employ it and employ it properly, it will benefit their model, but we hope that they would be a sound business in the first place to be able to do so. We wouldn't necessarily think a bad business, which is suddenly employing AI, becomes a good business. And you've got examples of that. I mean, I'm not saying CoreWeave is a bad business. That was trading on an extended valuation. It's almost a poster child for AI exuberance within the market. Now, we didn't hold it. As soon as there was this softening of data coming through there, you saw that stock off by about 30%. Now, we wouldn't want to go into a company on such a binary AI good or AI substitution for their business. We would want to see businesses employing it, improving their efficiency. But at the heart of it, if you're producing, in the case of Train, heating and ventilation technologies, keep doing that, because that's what's making you your margin.
Okay, brilliant. Guys, just as a reminder, please, if you want any questions, send them through. I'll check up on the questions in a sec. So if they're topics that we maybe not discussing, you want Amit to deal with, hopefully we'll have a chance. Amit, the second issue is tariffs. Now, when Trump announced tariffs, Liberation Day, 2nd of April, massive shock, right? And I think initially people thought this was a negotiation stance and that these tariffs would be negotiated away into something much more manageable. There would be a whole lot of concessions extracted from countries, and we wouldn't have to deal with the tariffs as they were put forward. It turns out, no, the tariffs are fairly chunky, and they are having an impact. How did you guys deal with and are dealing with the tariff issue in terms of your construction? Does it mean you now think, ooh, the US is going to be hurt by tariffs because their consumers paying more? I need to find other jurisdictions. I need to find beneficiaries of tariffs. Has that played a role?
It has and it hasn't. I mean, it's so nuanced on a sector by sector and company by company level. And when we think about the tariff impact, you can almost bucket the equity universe into three different areas. Companies where they may have US manufacturing capabilities already, probably being the most insulated from this. Companies where they've got a commitment to increase capex in the US, and that's a very material, and they can evidence that we're building factories and capabilities there. And then companies where they're not building out that capacity, and the question for them is, well, what are you going to do with this increase in terms of the tariff picture? Are you passing it to consumers, or are you eating that yourself? And we're invested across companies which sit within all of these buckets because inherently different sectors are doing different things. An example of a company with very strong US manufacturing capabilities is Volvo. This is Volvo, the electric trucking company. It's not the it's not the consumer, internal combustion engine fleet that you and I would buy. It's commercial fleets of trucks. They have US manufacturing capabilities. They weathered the storm of tariffs incredibly well as a result and barely had any impact. The stock very much is still sensitive to their order book, their inventories, but much less impacted by the tariff situation, for example. Then you have companies like, let's say, some of the chip manufacturers, where even a stock like TSMC, okay, we're going to nearshore some capabilities, then going into factories or foundries in Arizona, for example, and onshoring some of that to the US. But crucially even if they boosted some of the manufacturing, they've been very careful to ensure the real secret source of the foundries that they have within Taiwan remain the competitive edge. And of course, there's their own reasons for that. But again, that's a good example of a company where they're thinking about those US capabilities and building them out. And then on the last category, an example of that are some of the beverage manufacturers. And admittedly, it's not been a great sector for a while, but the Heinekens, the Carlsbergs of the world, they've stayed very much true to our manufacturing capabilities, our production capabilities aren't in the US. In the previous Trump administration, there was some increase to consumers as far as prices go. They continued buying our goods. We may have to swallow some of that ourselves, but for the time being, let's wait and see. So we're not excluding any one particular sector or stock. We're having to treat all of these on an individual basis. But it has made that picture very challenging just from a political noise perspective. Because if we were talking a couple of months ago, it felt like there was more complacency around the taco trade of Trump always chickens out. And to your point, he's held pretty firm on a number of these things. And whether or not on a go-forward basis, there's now more of a softening or not, it's posed a question there of, well, maybe there's not going to be.
Yeah.
And it just increases that uncertainty on management of all of these companies. How do they deploy capex going forwards? And this is the picture we've really seen since the start of the year. It's just uncertainty there.
Okay. And then the last sort of topic is interest rates. It's in a big focus now. Trump has put the Federal Reserve under enormous pressure. Within the Federal Reserve, you've got Chris Waller, who has dissented and obviously putting the pressure on. The Senate appointed a new person to the FOMC who's a Trump person, no doubt will vote for rate cuts. How big a factor is a resumption of interest rate cuts? So let's assume that there's now a cut tonight, 25. Let's assume there's a cut in October, there's a cut in December. How does that factor into the portfolio thinking at this stage?
From our perspective, we wouldn't position ourselves necessarily for a rate cut per se. the way we've expressed that and want to get interest rate beneficiaries in is, again, through the stock selection and some of the plays we have within the bank sector. And there again, if we're choosing the best of breed banks, regardless of the interest rate backdrop, we'll benefit from that in some way. So whether that's increased volatility through some of the stock exchanges or more trading revenues coming through names like a Morgan Stanley, for example, or some of the other investment banks or some of the other brokerages in the US, we believe if we get the stock selection right, we can benefit from that primarily through stock selection. We haven't shifted the portfolio materially in the lead up to today's event or the announcement today. But if we see a wholesale change in the market, it's more of a case we will have to adapt to that rather than trying to make a binary call on overexposing the portfolio to interest rate risk per se. So again, I would draw that back down to stock selection there. And indeed, on the other side of that, concerns around inflation, are more heightened now than we would have said a year ago or even 6 months ago. And there's signs of that really picking up in pockets within the US. And I don't think that's a surprise to anyone. It's, again, a case of just, if you're focused on that company quality there, we believe that that will endure over the course of that market cycle then. And equities remain a great hedge against inflation overall at an asset class level.
100%. Especially if you hold them for the longer term. Okay, so we've got a couple of questions here. I just want to ask you this one because it relates to the macro environment in the US. Is the slowing US job market and falling inflation a signal of a coming bear market? Well, I think inflation's on the rise in the US, but let's talk about the job market. Is it, to use a concern about a looming bear market?
I don't think a looming bear market per se. We pay very close attention to what's happening in the labor market. And the data's weakened, it's softened, but it's not cracked dramatically. There was the one report that came through a couple of months ago where it did undershoot a great deal. But since then, it's, again, stabilized. It's not been overly negative. Manufacturing PMI's softer, but there's nothing there so far which is really flashing red. And the services PMIs, again, have remained relatively solid over this time period. So I think it would be too strong to say the data right now is pointing towards a bear market. The more concerning thing is just this disconnect between some of the weakening pockets of economic data and an equity market which has just ground upwards.
Yeah.
Now, that's something which we're much more mindful of is you've got, let's say, outside of the US, much more conservative consumers within Europe, within the UK, within Japan, within China, a relatively still strong consumer within the US, which is almost carrying a lot of that on its back then. And we're having to make sense of weaker economic data or softer economic data versus a market which almost seems to shrug that off and just keep going. And that's where, again, this ties together the momentum point, this ties together the interest rate cuts point, the extent to which that dispersion or that difference really continues to play out.
And I mean, we had yesterday retail sales out of the US. It was way better than expected. It didn't suggest the consumers capitulated at this stage. There's a question, I think I want to broaden this out into around exposure to other markets. So obviously the US is going to dominate a lot of this, but this is a global fund, right? Have you been, is there a greater exposure to emerging markets, indirect exposure to emerging markets or to other jurisdictions, and purposely moving away from the US? To what extent has that occurred?
We haven't deliberately moved away from the US. In fact, it was a slightly contrarian call post-Liberation Day where we were much more overweight Europe at the end of the first quarter. And we added back to our US, and we've taken some of the proceeds there from Europe primarily. We've initiated some new positions in some Chinese names, so it's the first time in a long time we've done that. We've also beefed up some of our Japanese allocation. So it's, from a regional perspective, we've really closed in around what the benchmark is kind of saying, as we're not deliberately taking a country or a regional view or expressing a strong view on that. Are there opportunities within Europe at the moment on the industrial side, the financial side? Yeah, we increased some of our weight. Siemens is a good example of a name we put into the portfolio. We've also continued to hold some of those more European defensive names, like a Munich Re, for example. But we're also going down, and some of the cyclical names we've instituted as well. Coming into Japan, Mitsubishi UFJ is in the portfolio, Japanese financial group. The Chinese names I mentioned before, Tencent playing Chinese technology, Yum China playing Chinese consumer. There's lots of interesting ideas around the world that are at play within the portfolio. The US still remains 60-70% of our benchmark. We're not trying to avoid that. We've found good opportunities there as well. But these are all global businesses at the heart of it.
Yeah.
And we're not making a call on US GDP versus European. It's a play on the valuation opportunity we can get. And is this company doing something interesting which will grow in the future?
Yeah, no matter where the jurisdiction is. Okay, we've got other questions, but I just want to discuss the performance of the fund. So the performance has slipped. I looked at the performance. I think it's still good in relative terms, and obviously the long-term performance is brilliant. Do you want to chat around that underperformance, and to what extent is that a concern or a focus right now?
So, likewise, and just connecting with our discussion a bit earlier, let me see if I can get the slide up. 1 second. But the momentum rally that we've seen has been damaging to relative performance because many of these names aren't where we really fish in. And just looking at that performance there, again, the longer term track record still remains very much intact. But to draw your attention to that 1 year number there, at the overall strategy level, yes, we have lagged this market behind by almost 4% there. And we haven't held many of those momentum beneficiary style names. The recovery in performance, and this is to the end of July, but if we took this to the end of August too, the recovery in performance has largely been that balancing of the portfolio and getting a bit more risk into it. The process that we use anchors so much on long-term fundamentals that this market that's really been dictated by short-term revisions really doesn't play in our favor. And it's not an environment where we're surprised we underperformed. We've done soul searching. We're looking at lessons we can take from this. There's some stock specifics I can go into as well, but we're not overly alarmed at the overall process level to say we're surprised by this underperformance most recently, particularly against such a momentum-driven market.
Okay, brilliant. I mean, if you take the time to look at the performance 3 year, 5 year, this fund is superb. This is world-class stuff relative to the MSCI World Index. For me, it's brilliant. And as you say, yeah, I mean, short term, it's pulling back that underperformance. We've got a question around concentration risk, and I think that's a valid question in terms of the Mag 6 or the Mag 7, depends on how you see that. Do you think there's a concentration risk at the moment?
This is the most this is the most narrow the market has been. And the rally that we saw, and again, thinking to the end of 2024, all the discussion was there's going to be a broadening out of the equity market returns. And we had some of that after the first quarter, and you've seen Europe starting to perform. Every market you mentioned before has rallied over the course of this year. From a US perspective, it's still largely led by this narrow cohort of names. But again, almost 2/3 of companies actually beat on earnings in the S&P 500. It's not a case where companies aren't delivering earnings against this backdrop. And so for all of the uncertainty in the world, geopolitically, the economic data softening, companies have still continued to perform very, very well. And just to give you an idea, I mean, we talked about Mag 7 or Mag 6 earlier. Some of our top holdings in the portfolio right now on this slide that we can see, our top overweights, Microsoft, Meta, and Amazon. We're about neutral in NVIDIA at the moment. We're slightly underweight as far as Broadcom goes. We're underweight as far as Apple and Tesla. We don't hold any Alphabet in the portfolio. But the point I would make there is selectivity within that cohort of names is key. And that's why in our view, we've deployed our risk budget behind 3 of those names at the moment, rather than all 7 of them. There's other areas of the market which offer a compelling valuation opportunity, but we don't want this to be a Mag 7 fund. And that's really key there.
Yeah, I think that's key. Otherwise, I think there's a massive risk down the line. And I think what people have to bear in mind is that there is a long-term view embedded within this fund. This isn't just simply, oh, the latest quarter, what are we going to position ourselves for? That's not what this fund is about and not what the process is about. If you've got 80 analysts around the world, I mean, that is a rigorous process of getting stocks into this fund overall. We've got a question on the returns in dollars versus rands. Won't you just explain how the returns are calculated in terms of a currency effect sitting in South Africa?
Yeah, so from a South African investor perspective, you're still getting exposure to, this is the same global equity portfolio that we deliver for any of our clients outside of South Africa as well. We hedge the currency exposure within the fund back to the benchmark. We're not currency forecasters.
Yeah.
If you want to buy a currency hedge share class, that's your choice as an investor.
100%.
But from our side of it, we try and mitigate as much of the currency exposure as we can. Perhaps with the exception of the emerging market currencies, we just bring those back to dollars, for example. But we try and mitigate as much of that currency impact within the portfolio as we can. So that what you're getting there, regardless of whether you're a rand-based investor, dollar-based investor, euro-based investor, is the equity market return effectively. And that's why, again, when we think about the portfolio and the risk exposures within it, we look to very explicitly minimize that currency exposure or the currency impact that we're seeing from around the world. So again, it's very much still equity market returns. We're not overlaying that with any sort of tactical currency views there.
Okay, and then in terms of what would you be, it's a tricky question, but what would be top of your minds now in terms of what are the big concerns? In other words, what do you think are the big risks out there that you guys need to be mindful of, investors need to be aware of? I take a lot of heart from what you've said is that you've got a messy macro environment, yet companies have delivered ongoing decent returns, and that you're clearly not struggling to find stocks to put in your portfolio. So what in that environment, what would you say we need to be most mindful of that could impact us and give us a bit of a jolt, that could be kind of a left field or something that's not on the radar right now?
I think leaving aside the inherent uncertainty at the macro political level, because we don't have any insight in terms of forecasting that. From a stock picker's level, the valuation and the global valuations right now, and again, this is using our JP Morgan valuation, our valuation spread, our P measure that we use within the equity desk. It's above the longer term average. And again, largely that's been driven by a handful of names, which has really led that market upwards. It's not a more concerning picture because it's still not over exuberant, but it's definitely at the point of it's above long-term averages right now. And at some point, you'll start seeing some of that pullback come through. Now, we don't know when that is. For the time being, this is a big part of the reason why, against this messy macro picture, against an not extended, but a more expensive valuation picture, just balance the portfolio as much as possible because it minimizes lots of those risks that we are kind of forecasting across the world. Whether that's the continued delivery of margins from a handful of companies, whether that's the overextended valuations in some pockets of, say, the US, whether the European defense trade can continue going on. If we just have that balanced portfolio and focus it on stock-specific risk, we mitigate as much of that as possible. And the key message that I would want to give anyone watching this today is just keeping and maintaining a balanced portfolio against this environment. And that's why, from a core portfolio management perspective, we've positioned ourselves accordingly against this backdrop.
Okay, can I ask a final question, which is really a South Africa question, and that relates to gold. The gold price has done well. If you had invested in gold a year ago or since the beginning of the year, spectacular. If you look at how the gold price effectively has impacted, South Africa's equity market. It's exceptional. The resource shares generally, South Africa have done well. From your side, where we've got kind of a natural affinity to gold because it's part of the history of the South African economy. From your perspective, how would you look at that as an opportunity? Is it something that even gets factored in? Do you look at a gold mine? Do you look at in any way trying to include something like that?
So I'll answer this in one of two ways. In Global Select, we don't have any out and out.
So you got no gold mines.
No, exactly.
Okay.
And inherently, that's because it's two reasons. It's when we think about the gold mining sector, they're very much a price taker as far as what the gold price is right now. And you really do trade off a lot of that quality that we hunt for in some of these resources sectors. So Global Select is actually probably quite a good complement to a portfolio of South African companies for that reason. The other side of it as well is many of them tend to be smaller companies. And we have an analyst who covers emerging market miners and just globally the basic resources sector. And from a global perspective, when we take that investment universe, yes, there are some really good quality. There's some good companies there that have delivered strong returns. But when you think about it globally, it's still a case of we just believe there's better opportunities on a relative basis elsewhere. So we haven't really fished into that pond or that water. We're not experts at calling the gold price. There's other portfolios that I actually look after and represent as well, where they have benefited from that. And that's largely been a case of improving balance sheets within the gold mining sector, consolidation there happening as well. And that's more broadly within the mining sector altogether. We've got Anglo and Tech Resources and some activity going on there too. But it's been very interesting post-Russian invasion into Ukraine, just how strong that gold price has performed. And it's not necessarily consumer buying. It's been the central bank buying and seeing what happened to Russia as soon as they were pulled off of SWIFT. And you've seen the marginal buyer of gold has really shifted to central banks rather than any other uses there. And I want to say, okay, the price looks expensive now. It's at all-time highs, but it's difficult to see.
A lot of people would disagree with you.
It's difficult to see where the end point of that is, given what's driving it. And it's not a case of just interest rate dynamics at play anymore. And remember, the gold price has rallied against an elevated interest rate backdrop in a large part of it. It's very much down to a geopolitical safe haven property right now, which is disconnected to what's really dictated gold historically.
Okay, I see I've got 2 minutes and I lied. I'm going to ask you a last question. You mentioned size of companies that go into the portfolio. Can you give us some idea of where that cutoff ends up being? Because there is a plethora of smaller companies that I'm assuming are brilliant, right? But given the size of your fund, given that you need to take a sizable percentage of the company in order to make a difference, where does that cutoff rest? And is that a limiting to your opportunity set in a world that is embracing new technologies?
So our bread and butter within our analyst network, within the strategy, and the reason why we manage it this way is we want to give investors a liquid portfolio as liquid as possible. I mentioned before, and on one of the earlier slides, the overall strategy that the STANLIB mandate also feeds into is now going upwards of $50 billion. Now, we frankly cannot invest in these smaller companies.
Yeah.
We would take such a material position in many of these names, and then you're sacrificing liquidity just for the sake of coming into them, and then you can't liquidate the position anyway. So we're very deliberate in terms of generating that outperformance, and you can see on that Morningstar plot, we believe and we wed ourselves very strongly to large, giant, mega cap companies in terms of where we find our opportunity set. If you want to look down the market cap spectrum, by all means, and couple this with that. But this isn't our ethos. This is not where we direct our research to.
Yeah, makes a lot of sense. Thanks, guys. That's the end of our webinar for today. Can't thank you enough for joining us. I want to thank Amit for being out in South Africa and for giving up some of his very valuable time. I certainly found it insightful. Please, as a reminder, we've got further webinars coming up. Please be on the lookout for that. If you want a copy of the charts, we can send that to you. Thanks for joining us, and hopefully we'll chat soon on another webinar. Thanks.